Hi, this is Steve. Welcome to my channel, Retirement Math, where we look at the calculations and formulas that can affect us during our retirement. In today's episode, we're going to discuss what happens if you have earned income while receiving Social Security. In this episode, I'll explain what the Retirement Earnings Test is, how it works, what the earnings limits are, and what types of income qualify. So the Retirement Earnings Test is a rule that temporarily reduces your monthly retirement benefit if you started your benefits earlier than your full retirement age and have wage-based income. So what is your full retirement age? That's the age at which you are entitled to 100% of your calculated monthly Social Security benefit. This is also known as your primary insurance amount. So how is your full retirement age determined? Well, if you were born after 1959, your full retirement age is 67. But if you were born in the years 1955 to 1959, your full retirement age falls somewhere between age 66 and 67. So what types of earnings are included in this test? Basically, any earnings that come from working. So that's going to include wages and salaries, net self-employment income, bonuses, commissions, tips, and maybe even earned vacation and sick leave if working and receiving benefits. The types of earnings not included are going to be things like investment income, distributions from a retirement account like an IRA, Social Security, inheritances and gifts, and other types of income earned prior to starting Social Security. Now, please keep in mind that I am not a financial planner or investment advisor, and this content is strictly for educational and entertainment purposes. All right, let's do the math. Here's a table to show how the retirement earnings test works using historical data. Let's walk through this example for Tom. Tom was born on July 4th, 1960. Since he was born in 1960, his full retirement age is 67, and he will reach that age in July of 2027. Now, Tom decided to start taking Social Security at age 62, and that would be in the year 2022. Now let's walk through the structure of this table. Across the top, we are looking at Tom's age from 62 to 67. And underneath his age, we have the year associated with that age. And under that, we have the months associated with specific points in time when the test applies for Tom. Now, on the left-hand side of the table, we have the age classifications for the two different tests. The first one being the earnings thresholds that apply before the year Tom reaches his full retirement age at 2027. And the second test, which applies to those months in 2027, but before he reaches his full retirement age in July. And finally, we show that the retirement earnings test no longer applies after he reaches his full retirement age. Okay, so now that we have the structure set up, let's discuss the data. The income threshold in 2022 is $19,560. Notice how this threshold increases each year. This is a positive. It has built-in wage inflation. Now, for Tom, he will only have 6 months of Social Security in 2022. So in this case, Social Security applies a special rule which takes the annual threshold and divides it into a monthly threshold. So for Tom, the earnings test is $1,630 for each month of earnings. And as shown, his benefit will be reduced by $1 for every $2 in earnings. And now the same sort of rules apply during the first 6 months of 2027. But this second test has higher thresholds and lower withholding rate. I'm going to call it that. So the earnings threshold for Tom in January through June of 2027 is $67,766. That's the annual number. You divide that by 12, and so his monthly threshold is $5,647. And now the withholding rate is $1 for every $3 in earnings. So not only has the threshold increased, but the withholding rate has improved. And then finally, in July through December of 2027 and beyond, there is no longer an earnings threshold, and Tom can earn as much as he wants. Now let's take a look at Tom's actual earnings. In January through June of 2022, Tom earned $50,000. Since this was before he started taking Social Security, the earnings test does not apply. However, from July through December, Tom earned $12,000. And for purposes of this discussion, let's assume that he earned $2,000 per month. Times 6 months is $12,000. Now the earnings threshold on a monthly basis is $1,630. So we'll take that and we'll multiply it by 6, and we get $9,780. Is Tom over the threshold? Yes, by $2,220. We apply the adjustment factor, so the withholding would be $1,110. Now in 2023 and 2024, Tom's earnings were below the threshold. So the earnings test does not apply, and there's no reduction in benefits. However, in 2025 and 2026, Tom is above the threshold in both years. And so the retirement earnings test applies, and there's a reduction of $300 here and $715 here. Now in 2027, we have a different earnings test. We have a higher number here. This essentially is replacing that number. So this is what's occurring in the year of Tom's full retirement age, but before he reaches it in July. And I'm also calculating a monthly number as well. And the withholding rate is now a reduction of $1 for every $3 in earnings, so even that has improved. So let's say Tom earns $70,000. Now this is where it gets a little tricky. Since he was receiving Social Security in 2026, it appears that the annual threshold applies completely to Tom's 6 months of earnings. So assuming that's the case, is he over the threshold? Yes, by $2,234. We applied the adjustment factor, and so the withholding is $745 from his check. Now the distinction here is if Tom would have started Social Security in, say, January of 2027, then the period from January through June would look at the monthly number, not the annual number. So keep that in mind. Now, in July through December, he earns $70,000. Well, he reached his full retirement age in July, so earnings test no longer applies. Now let's look at some of the intricacies about what actually happens. Now let's bring this full circle. The big secret is this. The reductions to your retirement benefits is only temporary. They are not permanently lost. Instead, they will be returned back to you through a higher monthly benefit going forward. Now here's basically how it works. First, Social Security will add up all those temporary reductions. In Tom's case, the sum of all these is $2,870. Next, they will use a formula to amortize that amount over Tom's lifetime, and it could work something like this. You take the $2,870 divided by 30 years, and take that number divided by 12 to get the monthly amount. So in Tom's case, he would probably receive an additional $8 a month for the rest of his life. Now, the last thing I would like to discuss is how all of this works in practice. I'm sure everybody has a different experience based on their situation, so I'm going to describe the simplest example I can come up with. So let's assume that you know that you will exceed the earnings threshold in 2027. So in late 2026, you notify Social Security. They apply the retirement earnings test and calculate your benefit reduction to be $1,200. And let's also assume that your regular benefit amount is $2,000. Well, starting with your January payment, your monthly payment of $2,000 will be reduced by the full amount of the reduction. In other words, your benefit payment for January will only be $800, which is the $2,000 minus the $1,200. However, all future payments for that year will be the full $2,000. In other words, temporary reductions are front-loaded in a year. And that brings us to the end of this episode. I hope you have found this topic educational. If so, please like this video and subscribe to my channel, as I'll be producing more content like this.